Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The tariff rout deepens. Stocks tumble from Sydney to Mumbai, sending the Asian benchmark down more than 7%. Its biggest intraday drop in more than 16 years. US and European futures point to more falls ahead. President Trump dismisses the market slump, saying a boom is on the horizon. Treasury Secretary Scott Bessent disputes the tariffs will trigger a US recession. Plus, Jay Powell says the economic impact of tariffs is likely to be larger than expected. He says the Fed will focus on keeping inflation under control. Good morning. Happy Monday. The markets capitulate. There is no Trump put. There is no Fed put. In fact, the US president is doubling down on an economic policy that most economists think is de-anchored from reality. European futures pointing lower by more than 4% after the rout of last week. The Nasdaq 100, don't forget, is already in correction territory, dropping more than 15%. Here in the UK, FTSE 100 futures pointing lower by 2.3%. S&P futures building on the tremendous losses of last week, pointing lower by 3.5% on the US benchmark. The tech-heavy Nasdaq 100 futures pointing lower by more than 4.4%. Let's flip the board and have a look cross-asset day. JP Morgan suggesting a recession is in the cards now for the US. Goldman Sachs ramping up their expectations of a US recession to 45%. Money continues to move as a safe haven flood into sovereign debt. US Treasuries a bid once again. The 2-year in focus. Yields down 14 basis points, 3.5 right now on the 2-year. The Japanese yen also bid up 0.7% in the session today, and Brent at 63.91. WTI close to $60 a barrel. A further squeeze on oil prices on these recession risks, down 2.5%. Gold also off in the last 3 days, just above $3,000 for the yellow metal, down 0.1% in the session today. Let's cross over to Asia right now. Huang standing by in Singapore. Hard to know where to start because the bloodletting in Asia is deep and pronounced as China comes back.
Absolutely, Tom. I mean, carnage, panic, bloodbath doesn't even begin to cut it. And you look at the declines on the region's benchmark, worst since 2008. It is across all asset classes. We're seeing the reeling from this ramped up tariff war. And it is also across geographies, across sectors when you're looking at stocks. Really interesting as well. The likes of the Singapore benchmark, normally seen as very stable, plunging by the most on record. That tells you a lot. The difference this time around for traders that are looking for reference, is this as bad as GFC or March 2020, is that if you're comparing this to the early days of the pandemic, Powell doesn't seem like he's willing or very eager to kind of swoop in with support. And for China, that's back from an extended weekend, it just shows you how they are also part of the tariff pain, because there was speculation that the optimism of Chinese support measures would mean that the declines were not as bad today. But look at the Hang Seng, almost 11% down, the worst decline since the GFC. We're looking at the Hang Seng Tech Gauge is the worst on record since 2015. Flip the board. The question also becomes what China is going to do amid these tariffs. If you look at some of the moves on the renminbi in the first tariff war, depreciation of about 10%. Some strategists say this time around we could see 15% devaluation of the yuan, as much as 30%. We have the likes of Mizuho saying, no, that's not the case, that the PBOC is unlikely to want the yuan to devalue because they want to anchor growth expectations, and they also want to prevent capital outflow. So keep that in mind, even as we see the renminbi taking a hit today.
OK, Huang in Singapore, and that debate will only intensify around moves focused on the Chinese yuan and what the PBOC has up its sleeves on that front. China, meanwhile, flagging potential rate cuts and stimulus measures to defend its economy from US tariffs. On Friday, the government imposed a 34% tariff on all US imports. Our China correspondent Min Min Lo joins me now with the details. Min Min, get us up to speed on the Chinese response.
Yes, I think it's very clear that this time China had responded more forcefully and more swiftly as well. They didn't wait until April 9th when those US tariffs kick in. They announced early on that they're going to respond with these countermeasures, 34% tariffs on US goods, essentially proportional to what the US has imposed on China, but also a series of non-tariff measures, including export controls on over a dozen US companies, export controls on about 7 of these critical minerals, and also stopping the import of sorghum, poultry from a few US companies. So the consensus so far from what strategists and analysts are saying is that China's response still is pretty proportional and very targeted, still centered around a few key sectors, including agriculture and the defense sectors, which are Trump's key constituencies. But very critically, though, China also signaling they are not closing the gate for negotiations. This was explicitly stated today on the front page of the People's Daily, the Chinese Communist Party's mouthpiece, saying China is not closing the gate for negotiation, but they're also not taking any chances, and that's why they're responding forcefully. They're not going to take these US tariffs lying down. And the editorial also saying that the Chinese government will take extraordinary measures to support the domestic economy, support domestic consumption, stabilize the capital markets, including potentially cutting interest rates and the triple R as well, in order to maintain the economy's resilience amid these tariff risks as well.
OK, Bloomberg's Min Lo in Hong Kong on the Chinese response as we count down, of course, the implementation of 34% tariffs on China. 10%, of course, for all 60 nations has already been implemented over the weekend. April the 9th is the deadline for all of those additional tariffs to kick in, including those on China. Meanwhile, Donald Trump and his economic team have dismissed investor fears of inflation and recession, insisting a boom is on the horizon. The US president says any deal to trim tariffs with affected nations must lead to the elimination of the US trade deficit.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that, because to me, a deficit is a loss. We're going to have surpluses who are at worst going to be breaking even.
OK, and of course, for most economists watching this, a deficit is not necessarily a loss. Let's bring in Bloomberg's Derek Wallbank with reaction to what we've heard from the president, seemingly, Derek, just doubling down again on a policy that many economists would take issue with.
That's exactly right, Tom. And look, I want to tell you that the quote that struck me the most that Donald Trump was talking about, he said he compared it to a patient that needs to take their medicine before they can get better, right? So the president and the White House and all of the top economic aides are unbowed right now amid the market sell-off. Now, we'll see what the reaction is going to be when they get in the morning. Obviously, we've seen an absolute sea of red across pretty much everywhere in Asia so far, and the futures in the U.S. don't look much better. So that, that's going to be remaining to be seen as the pressure sort of goes up. But right now, there has not been a break among Trump, among most of his top allies, among the people in Washington who are advising him. The U.S. Senate had an opportunity to disavow this in a vote on Friday, chose not to on party line votes. House Speaker Mike Johnson, who, as you know, pretty much owes his position atop the House Republican Conference to Donald Trump's own interventions earlier this year, has been calling people, saying, stay the course, stay the course. Again, as this goes on, you sort of see how much pressure comes forward. You are talking about declines where you have to go years and years and years back, sometimes more than a decade back in some Asian markets to find parallels. That does build pressure, especially for a president who likes to talk about how the economy is a great test of how he's doing. But so far, he's saying right out the pain and the future will be brighter. That's the line from the White House right now.
Yeah, and if you take him at his word, then he wants surpluses with countries like Angola, where you have a per capita income of about $2,000 versus $82,000 in the US. And this is what economists would say. The US is the wealthiest nation on the planet. That's why there's a deficit, because the consumer is so strong. Bangladesh as well, facing tariffs of 37%. presumably the Trump administration wants a surplus there as well. The markets had thought that Treasury Secretary Scott Bessent would be a safe pair of hands. He came out and spoke over the weekend about the market reaction to these tariffs. Let's take a listen.
I reject the assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week. What we are looking at is building the long-term economic fundamentals for prosperity that I think the previous administration had put us on a course toward financial calamity.
Derek, talk to us about the cracks that we're seeing. JP Morgan are forecasting a recession. Goldman Sachs have revised the odds up to 45% this year. What are you looking at?
Well, I'm looking at a couple of things. The first one of those is the fact that the White House is talking about short-term pain, long-term gain. How long does that short-term last, right? That's point the first. And how deep is that pain? I think both of those are relevant questions. And then where do you start seeing some upside? How long is okay for that? Bear in mind, if you're talking about political cyclicality in the United States, you are at the very start of a 2-year election cycle. The next midterm elections aren't until November of 2026. That is a very, very long time until something comes, unlike a lot of other places where you get snap elections, and that doesn't happen in the United States, right? So that's not a worry. The Trump team is ensconced for a little while. They have some time politically to sort of ride this out. But the pressure will increase as things go on. The other thing I'm watching for is going to come at 2:30 p.m. U.S. Eastern Time, and that is when Trump and Benjamin Netanyahu get up for a joint press conference. Now, I'm watching this particularly because Bibi is one of Trump's closest friends on the world stage. Israel is a close ally, and Israel had taken steps to try and get rid of its barriers to U.S. goods coming into the country. They did this ahead of time. They were wrong-footed by the trade deficit calculated tariffs that came in of 17%. So you're talking a close friend. You're talking a country that has already taken tangible steps to reduce a trade barrier. If Bibi can get some relief from this, then maybe that's a path forward that other friends of America can kind of take forward. If he can't, then it raises the question again, what will it take to go forward? So for everyone thinking of a negotiation, you have an opportunity to witness a potential negotiation in near real time with one of Trump's closest friends who has already taken action. I think that I couldn't put the word more than critical. It's going to be absolutely critical to watch. Open your thesaurus, find something else that's bigger, but you got to watch that. That's going to be really, really important as a signal going forward.
OK, Derek Woolbank on the political framing as this around that 2-year horizon. And, of course, in the near term, that press conference between the Israeli Prime Minister. If the Israelis can't get a deal, then who can? Thank you, Derek. Now, Fed Chair Jerome Powell says the economic impact of new tariffs is likely to be significantly larger than expected. Speaking on Friday, Powell said the central bank will focus on keeping inflation under control. Bloomberg's Valerie Teitel is here with more. Val, talk to us about the Powell response to the market rout.
Look, the market is clearly telling the Federal Reserve, I don't know how patient you can be. We're seeing a decent bull flattening of the yield curve. That's a rally led by the front end. That 2-year yield is down 13.5 basis points, and the odds of a Fed cut at the May meeting have now gone up to close to 60%. But there are some market commentators out there claiming that the Fed can't wait until May. They need action earlier. Take a listen to JP Morgan's Bob Michael.
If you go back to Friday, the Fed can talk tough. They have to be looking at this. I don't know if they can even make it to the May meeting before they start bringing rates down. I think this is a serious moment. I do not think the Fed can just sit on the side.
All right, emergency, talking about a perhaps emergency cut even before the May meeting. Maybe some speculation around that will grow if we continue to see this equity market slide. If we flip on, just take a look at how S&P futures are faring, Tom, because if this move holds into the close, we could be looking at the 3 worst days for the equity market since 1987. And let's take a look at the worst 2 days since World War II. If you flip on, the Trump tariffs have joined the list of of Black Monday, the GFC, COVID, and the extent of its two-day slide. What makes this starkly different, Tom, is after those three events, the floodgates of fiscal easing, of monetary easing opened. It seems like for now, we are not headed for that anytime soon.
Yeah, not necessarily a list you want to be on, and particularly given that much of this, of course, has been self-imposed. Bloomberg's Valerie Teitel, thank you very much indeed. You can, of course, keep up to date on the latest news and market reaction from the tariff rollout on your terminal by typing TLive-GO on the Bloomberg terminal. Coming up, European trade ministers meet today as Trump's tariff threats upend global markets. We're there live with the latest. That's next. This is Bloomberg. EU trade ministers meeting in Luxembourg today to begin discussing how to react to President Donald Trump's tariff package. For more, let's go over to Bloomberg's Oliver Crook, who's on the ground for us. Ollie, what are we expecting to hear from EU leaders then meeting today?
Yeah, so Tom, after that shot was fired last week and these imposition of tariffs, which will come in on April the 2nd for that, April the 9th for that 20% tariff, this is really the EU's first chance to get together collectively with trade ministers. They're meeting here in Luxembourg in order to find a unified approach to how to deal with Donald Trump and his imposition of these tariffs. Already we have some disagreement at the very highest level within the EU, the biggest country within countries within Europe, really debating about how to go about this. We heard from Emmanuel Macron last week saying that basically telling, European companies not to invest in the United States. We heard from I have to say, very sort of punchily from the German Vice Chancellor, the Economy Minister, Robert Habeck, likening this event to the invasion of Ukraine by Russia and its impact, saying that basically we need to rise with the same level of force in order to meet that. On the other hand, we have heard from the Spanish, we have heard from the Italians saying, listen, let's keep our heads cool, let's have a sort of level-headed approach to the United States and Donald Trump and really go into negotiations. I think for everybody in Europe, the ideal outcome is to have a negotiated solution with Donald Trump. But listening to the various cabinet members, listening to Donald Trump over the last few days, I'm not sure that this is an administration that necessarily is in a rush to cut a deal. And I think the Europeans will be cognizant of that fact. So as a consequence, they will need to have their list of sort of maximum pressure that they can deliver going into these discussions so that they can say, hey, listen, this is what we are willing to do. We should also say, Tom, there's another side of this coin. This is a point that we keep making, but it's one that I think is very, very important. There is the China side of things. When you have these trade barriers being erected by the United States on all of its sides, all of its trading partners, where does all that extra capacity go? It goes to the wealthiest market in the world. It comes straight here to Europe. That is going to be a top concern for trade ministers as well.
Ollie, as you talk about China, a line crossing the terminal right now. This is a red head across the Bloomberg terminal from our team in mainland China. China is discussing front-loading stimulus to counter the tariff threat from the United States. Meeting, of course, over the weekend, leaders in Beijing discussing what they can do to stabilize the economy and markets in response to those tariffs, including accelerating stimulus plans to boost consumption. You're getting a bit of a move in terms of USD, CNH, and the currency, of course, the yuan in focus, 731 right now. That's a move of 0.2%. Equity markets, mainland China, down quite right now, around 6.4% on the CSI 300, but pairing some of those losses. What are the countermeasures then to the EU? That's the Chinese response that they're mulling. Of course, they're looking to retaliate as well. Yeah. What is the response likely to be? What have the Europeans got up their sleeve, Ollie?
The reality of the situation, Tom, is that what Trump is trying to address is the trade deficit that exists between the EU and the United States to the tune of about $200 billion in goods, right? It's a $1 trillion trading relationship. It's a very, very large trading relationship, the biggest in the world, and so that limits basically how much damage the EU can do on the question of goods. Remember, they've already got this sort of list of tariffs that they're going to retaliate with on the steel and aluminum. That's only about $26 billion. That's basically chump change compared to the amount of trade that is done here. What they can look at is starting to target the U.S. tech companies, starting to target services. That is where the United States runs a significant surplus of more than $100 billion. That is where they can potentially start to exert pressure. But again, if you listen to the Trump administration, you listen to Donald Trump himself, the United States is willing to endure some pain. There's also this anti-coercion instrument. This is a new sort of mechanism that the Europeans have developed over the last 5 years to basically be able to throw out a lot of the rule book in order to put impositions to sort of defend their own market. This is something that they're obviously going to be looking at. Whether or not they choose to sort of enlist that option, it would be a significant escalation, taxing digital services. But again, Tom, this is another thing that we need to keep in mind. That will need unanimity. A lot of these taxes will need unanimity among the 27. You have Hungary that is decidedly on Team Trump. That complicates the situation. And of course, Tom, we'll throw it forward to Friday when finance ministers convene to basically discuss how they can also shelter their economy from some of the damage that's coming. But there is a lot of work for European officials to do over the next couple of weeks.
OK, and you'll be charting that for us. Bloomberg's Oliver Crook on the ground for us in Luxembourg. Thank you. Now, at 7:15 a.m. UK time, Oliver will bring us an exclusive with the Spanish economy minister. Do not miss that interview, 7:15 UK time. Coming up, Israeli Prime Minister Benjamin Netanyahu set to meet President Donald Trump in Washington later today to seek a better tariff deal for Israel and discuss the war in Gaza. More on that next. This is Bloomberg. Israeli Prime Minister Benjamin Netanyahu is due to meet President Trump in Washington to seek a better tariff deal and discuss the war in Gaza. The meeting was prompted by the 17% tariff the US is due to impose on some Israeli goods. Horizon's Middle East and Africa anchor Jumana Pasechi joins me now from Dubai. Jumana, what are you going to be watching for when it comes to Netanyahu's visit and meeting with Trump later?
Yeah, well, I think it's important to point out that this is actually the first foreign leader to be meeting with President Trump since the tariff announcement day in person. So this was done at the request of Trump himself. And equally, what I should say is the day after those tariffs were announced, it was met with a bit of surprise from Israel, particularly because the day before, they themselves had tried to preempt the tariff announcement by reducing the amount of the tariff rate on U.S. imported goods into Israel to 0%. In anticipation of this tariff announcement, thinking that they could get off lightly. That wasn't the case. They found out pretty soon that they were also going to be subject to a 17% reciprocal tariff rate. So on the back of that, this meeting was then put together. Netanyahu arrived into D.C. yesterday. He will be having a one-on-one with President Trump later today. There will be a press conference. And the aim of these talks is, of course, to see if they could come to some solution on the tariffs front. Earlier, our colleague Derek Wellbank was saying that this is perhaps a good litmus test for other foreign leaders around the world, because essentially what Netanyahu is doing is flying to meet with President Trump, trying to come up with a solution, trying to get a deal. And, it all goes back to the art of the deal. This whole starting point with tariff negotiations is ultimately to get things moving in Trump's direction. So it will be a good litmus test there. But they've also said that Gaza, the situation there, will still be on the agenda, in addition to Turkey's presence in Syria and the Iran portfolio as well. So not just tariffs, but as ever, the Middle East portfolio too.
Yeah, and a reminder, the ceasefire in Gaza has collapsed. Horizon's Middle East and Africa anchor Jumana Pasechi following, of course, that meeting with that preview. Thank you, Jumana. Now, the Israeli military has backtracked on its account of the killing of 15 Palestinian medics by its forces last month. It comes after video emerged that appeared to contradict the claims that the vehicles did not have emergency lights on. The military initially said it opened fire because the vehicles were, quote, advancing suspiciously on nearby troops without lights on. A military official has since told the Associated Press that this account was, quote, mistaken. There's more coming up. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. China discusses front-loading stimulus to counter the hit from President Trump's tariffs. Stocks tumble across Asia, sending the benchmark to its biggest intraday drop in more than 16 years. President Trump dismisses the market slump, saying a boom is on the horizon. Treasury Secretary Scott Bessent disputes the tariffs will trigger a US recession. Plus, Jay Powell says the economic impact of tariffs is likely to be larger than expected. He says the Fed will focus on keeping inflation under control. Let's get to these markets then as they digest the lack of Trump put. There is no Fed put, there is no Powell put, there is no Trump put. In fact, the president is doubling down on a policy that has seen, of course, the Nasdaq 100 enter correction territory, seen more than $5 trillion wiped off the markets, and seen JP Morgan and Goldman Sachs raise their expectations for a US recession. European futures tumbling close to 4%, despite Bloomberg reporting that China could be pulling forward its stimulus measures to try and support the Chinese economy. The FTSE 100 on the commodity squeeze down 1.8%. S&P futures dropping sharply after the losses of last week, pointing lower by 3.3%. You are now potentially on track for the biggest drawdown in US markets since early 2020. Nasdaq 100 futures plummeting 758 points, down 4.3%. Let's flip the board and have a look at the marked move once again in the US Treasury markets with the 2-year front and centre. Yields dropping close to 14 basis points, 351 right now on the US 2-year. The Japanese yen is bid again as that safe haven move up 0.7% at 145. Brent under pressure. Oil prices falling for a third straight day, down 2.3% on Brent, and WTI close to $60 a barrel, falling 2.4%. On the oil story, let's bring in now Bloomberg energy reporter Stephen Stupczynski. Stephen, talk us through the moves that we've seen in these oil markets with WTI hovering just above $60 a barrel. Is this ultimately what President Trump is aiming for? We know he's focused on the US 10-year. We know he's focused on oil. Maybe this is a win for President Trump. Weaker oil prices. Where do things go from here?
I mean, this could be a win, I suppose, if you look at it. I think it would be a win if this weren't such a sort of demand destruction situation. I think the general view is oil prices are falling, not so much, partly because of OPEC Plus adding more barrels to the market, but also with the respect that potentially we might be going into a recession situation where American gasoline demand is much lower. Now, of course, Trump has said that he wants, and people in the administration have said that they want oil prices, both WTI and Brent, the international benchmark, to be closer to that $50 level. We're just above 60 right now, as you said. So we are getting closer to that. But 3 days of declines, that just adds to this general, sell-off across the board from other commodities, from equities. And it raises the question, it sort of indicates that the market traders are expecting demand just isn't going to be there. Now, there are other things fueling this as well, right? So you had OPEC Plus come out with the surprise hike in production from May, from output. So they're going to increase at threefold compared to what they were going to before. And you also had over the weekend Saudi Arabia cutting their prices to some of their biggest customers, further adding to that bearish element. But right now, the focus is on the U.S. and China and the trade war and what that means for the global economy.
OK, Bloomberg's Stephen Stupczynski, thank you with the update on the oil markets as we look ahead to the OPEC Plus response, potentially with WTI again at around $60 a barrel. On these US recession fears and the question of reduced demand. President Donald Trump, meanwhile, dismissing investors' fears of inflation and recession, offering no apologies for the market turmoil sparked by sweeping global tariffs. Speaking yesterday on Air Force One, Trump says he would not strike deals to cut the highest tariffs unless they eliminate the US trade deficit with that country.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that because to me, a deficit is a loss. We're going to have surpluses or we're at worst going to be breaking even.
Okay, for the market reaction, let's bring in Francoise Huang, Senior Asia and Global Trade Economist at Allianz Trade. Francoise, good morning. Thank you for joining us. If you listen to the president then, he wants surpluses with countries including apparently Bangladesh, Cambodia, Vietnam, not to mention India and China. To many, that would seem economically ludicrous. What does this mean for the global economy that we have a president who is determined to make these adjustments?
Yeah, good morning. Thank you for having me. Indeed, these tariff announcements last week came in harder than what we expected. So what we expect in the short term is definitely GDP growth forecast downgrades across the board. For example, for the US now, we expect 0.8% growth this year with probably a slight recession in the second half of this year. Inflation likely also to increase, with potentially the Fed waiting later this year to October to deliver the first rate cuts, waiting for inflation to fade a little bit, and indeed that we see the economic slowdown to materialize. In Asia, of course, the region is the most badly hit by the tariff hike announcements that came last week. For now, for China, we have kept our growth forecast the same as we had before, 4.6% this year, provided that we have fiscal stimulus, heightened fiscal stimulus that is delivered. And we seem to already have some messages from the policymakers in that direction.
Yeah, Francoise, what is the potential offset of ramped up Chinese stimulus, bringing forward their stimulus plans? Again, according to Bloomberg reporting, to what extent can that offset these 34% tariffs?
Well, our baseline for now is that they will deliver what's necessary to offset. That's why we kept our GDP growth forecast unchanged. This year, 4.6%, 4.2% next year, keeping in mind that officials kept their official growth target for this year unchanged at 5%. So they delivered really a strong message earlier in March. They delivered already a strong message that they want to provide the policy support necessary to try and mitigate the external headwinds that are going to come from the trade war with the US. So already in early March, they delivered nearly 3 trillion renminbis of fiscal stimulus, which was stronger, basically the strongest we've had since 2022, since the height of the pandemic. But what we read also between the lines is that they were keeping the door open to do more, especially accounting for the fact that they knew the trade war was likely to be heightened. They knew that they were going to retaliate and potentially also bring on further response from the US. So it seems that Chinese authorities are planning for that. We expect more action, especially on the fiscal side, hopefully more on the consumer, and of course the real estate sector, which has dented confidence, private sector confidence for a few years now. The monetary policy side, we do also expect some policy rate cuts, but that might be a bit more gradual and measured, because they don't want to make the currency depreciate too much either.
Jay Powell of the Fed suggesting that, look, this is a Fed that's prepared to kind of essentially sit on the sidelines and see how this plays out, saying, yes, it's going to squeeze the growth, it's going to push up inflation, but they're in no rush to act. How sustainable is that position?
Well, indeed, we also expect that the Fed looks at what happens to inflation, right? So higher tariffs, of course, will mean that probably US consumers will have to pay a large part of that. For now, we have some estimates thanks to the front loading of US imports that we've had since the end of last year. We expect that those higher imports, this front loading of shipments from US companies, might help to support and provide for US consumers for the next few months, for maybe the next 6 months. But ultimately, we expect US corporates will likely have to pass on the tariff hikes and the higher markups to their customers. So we expect US inflation to peak at around 4.5% this summer. This is clearly above the Fed target. So in our baseline scenario, we expect the Fed to step in with a rate cut only in October this year.
Not until October of this year. So further pain then if the Fed is standing on the sidelines until October of this year. What about Europe then? The fiscal stimulus, the push on infrastructure and defence spending, is there more that is Europe going to have to pull forward its own fiscal stimulus? And to what extent can Europe offset the impact of 20% tariffs?
Well, indeed, that's also something that we looked into recently. Well, we have the European Union discussing from today what the response could be. In our baseline scenario, we expect that actually only China and the EU to some extent are in a position to potentially retaliate and maybe force the US towards a negotiation and towards a deal to bring down, again, the tariff rate towards Definitely not as low levels as we had before the Trump administration, but at least lower than the plus 20 percentage point that we've had last year. So the EU will look into measures. There's already a lot of fiscal stimulus on the table in this defense and infrastructure projects, as you mentioned, and potentially more measures could be discussed.
Yeah. Francoise, before we let you go, what would it mean for the global economy for a president who pursues a policy that sees the US having a surplus with all of its trading partners? A surplus or break even. That's what he said on Air Force One. He wants a surplus or break even with all of its trading partners. What would that actually mean for the global economy?
Well, first of all, for us in the short term, it doesn't really seem possible. So the short-term reaction or the short-term impact is that we expect a recession in global trading volume, global trading goods this year of around minus 0.5%. So the short-term impact definitely is that we'll have a lowering of imports, of course, from the US, but probably not to the extent to allow for, as you say, a break-even, or as Mr. Trump says, a break-even of the US trade balance. We did, for example, some of the calculations for Vietnam. Could Vietnam indeed increase in its imports from the US such that the trade imbalance is filled? Even if Vietnam sources all of its aircraft, soybeans, cereals, corns, and further products that are exported by the US, even if that happens, the gap will not be filled, and that even is assuming that the US actually has the production capacity to provide sufficient exports to the rest of the world. So for us, the short term is unfortunately a recession in global trade in goods, and very low likelihood that we actually do see the US trade deficit being balanced.
Okay, Francoise Huang, with that case study around Vietnam, important senior Asia and global trade economist at Allianz Trade, forecasting that recession in global trade. Thank you for the analysis. Now, some other stories making news this Monday. The UK is taking the first steps to help businesses withstand US tariffs by easing the government's electric vehicle sales mandate. The changes will give car makers more time to prepare for the 2030 phase-out of the sale of combustion engines. Prime Minister Keir Starmer, meanwhile, says he'll announce further measures this week to support Britain's economy and businesses amid the threat posed by US tariffs. Senate Republicans have taken a major step towards enacting President Trump's tax cut agenda and increasing the US debt ceiling. On Saturday, the Senate passed the budget resolution by 51 to 48. That was the margin. The measure allows congressional Republicans to craft legislation to extend Trump's 2017 tax cuts for individuals and closely held businesses that expire at the end of this year. And Bloomberg has learned that President Trump was close to an agreement with ByteDance over TikTok's ban in the US, but the deal was called off after China withheld its approval following the announcement of so-called reciprocal tariffs. On Friday, President Trump extended the deadline for the sale of TikTok's US operation for another 75 days. ByteDance says any agreement would need to be approved under Chinese law. Coming up, billions of dollars worth of acquisitions and IPOs are on hold as Donald Trump's trade war upends the global economy. We're going to discuss this and the wider tech outlook with Ludwig Ensthaler, the general partner at 468 Capital. That's coming up. This is Bloomberg. Good morning. Or is it fear and loathing in these markets? President Trump doubling down on his policy. China talking about bringing forward stimulus, but the market's looking through that event. The HSI over in Hong Kong down close to 12%. Euro Stoxx futures after the double-digit losses of last week pointing lower by more than 4%. S&P futures pointing down by 3.5%. Nasdaq 100 futures currently pointing lower by 4.4%. S&P futures set for their worst three-day plunge since October of 2008. The Nasdaq 100 is already in correction, and futures are heading for the biggest bust since the dot-com collapse of 2000. Bloomberg has learned, meanwhile, that billions of dollars worth of acquisitions and IPOs are on hold as President Trump's trade war upends the global economy. Sources say ticket platform StubHub, fintech giant Klarna, and trading platform eToro have all paused their planned listings as markets extend deep losses. The stock rout is also affecting M&As, with companies like Saint-Gobain and KKR holding off on deals, others revising down revenue projections for the year. For a finger on the pulse of this European tech market, let's bring in Ludwig Ensthaler, the general partner at 468 Capital. It's a venture capital firm investing in founder-led technologies, specifically focused on AI and the interlinkages with deep tech and robotics, which I know is a focus as well. Ludwig, good morning. What is the mood out there? The capital market's freezing up again. The capital market's essentially in collapse. IPOs being sidelined. What does this mean for European startups? What is the mood? What is the sense that you're getting from your investors and your portfolio companies?
Yeah, good morning, Tom. I think it's a very bad situation. Wherever you look at it, it's not good at all. So what typically happens when public markets, I think crash is the right word here. It trickles down to the private markets with a little bit of delay, and I think that's what we're seeing. Early signs of IPOs being pulled, M&As being pulled, and I also think that private funding rounds for tech companies are going to dry up substantially. So I think there will just be very little money left in the tech ecosystem in Europe over the next couple of months until this is resolved and until there is visibility on what's going on. So I think it's overall a very, very bad situation for tech, and for tech in Europe in particular.
What is the ability, Ludwig, of your portfolio companies and others to weather this storm, given your expectation that those fund flows are going to start to dry up?
Well, I think it's a case-by-case analysis that you have to make here, right? I mean, some of our portfolio obviously is extremely well financed, some of it is profitable, but I think those companies that were, looking to go out and raise a big round of funding, maybe to expand globally, maybe to invest heavily in new technology this year, all of that is maybe on hold right now. We don't know what it's going to be. So there's a lot of uncertainty here. And certainly that's not a great situation. If you look at Europe looking to be innovative, to push into some of the frontier technologies, especially as it relates to artificial intelligence, maybe into self-driving cars, other projects that cost a lot of money, that cost a lot of venture capital to realize. So, I think we will have to wait and see what happens. Unfortunately, we were just in a period in the ecosystem after, I would say, 2 or 3 muted years, that risk appetite was coming back to Europe, was coming back to, I would say, the late stages of funding, and that has been, I predict, has been killed pretty much overnight by these tariffs announcements and the crash in the public markets, unfortunately.
And we expect we should brace for failures. Then we should brace for companies hitting the wall and that funding drying up. And I mean, that's what we're looking at potentially is the shutting down of a number of startups across Europe as a result of that. Is that a fair assumption?
I think it's much more likely than not. I mean, the equation is pretty simple. In order to grow, you need capital. If that capital isn't available, you will have to stop, right? And a growth company that's potentially highly loss-making without a new capital injection will go out of business. So yes, I think that's definitely a net effect of this is likely going to be that we will see more insolvencies in the scale-up space in Europe over the course of the year or the next 12 months. I think, I mean, it's relatively early today, so let's see what actually happens. But I think that is a fair assumption at this point.
How are your founders thinking about the US market right now?
So I think in many ways, the US market for many businesses is still the most attractive market in the world. It's the biggest market. It's a very high margin market. It's one that's highly innovative. So I think our founders don't really think about it in political terms. They want the biggest market, or ideally a global market, available to them. So the desirability hasn't changed. I think, we will have to see if any of our software businesses, and most of our businesses on the AI software space, are impacted by that on an operational level. So I think from their perspective, that hasn't really changed. It's really, I think, first and foremost, the fears about the funding drying up that have really increased over the last couple of days.
before we let you go, you're focused on AI. You have that software focus, robotics as well. Where, if there are opportunities right now, what are you and the team looking at, Ludwig?
So I think there are great opportunities, right? That's the bizarre thing. We live in a time where we have great new platform technologies, AI enabling all kinds of things. If you look at the chatbot technology, if you look at self-driving cars, autonomous vehicles in general, with one particular new use case, which is defense, obviously, here in Europe. So I think there's plenty of opportunity. There's plenty of new technology to commercialize. There are great new use cases. So I think all of that is fine and really, green. We will just have to see in the short term. And I think this really mainly is a short-term issue, that we make sure that those businesses do get financed and that the flow of capital continues throughout this, I guess I should say chaos that we're experiencing in the markets right now.
Yeah, that is certainly one way to frame it. Ludwig Ensthaler, really appreciate your insights with that focus on European tech, of course. General partner at 468 Capital. Thank you. There's plenty more coming up. Stay with us. This is Bloomberg. The CBOE volatility index, the VIX, at levels we have not seen since 2020, certainly right now in that fear space when it comes to the spike in volatility on the back, of course, of the tariffs and Trump doubling down on that policy. Let's flip the board and talk and focus in on the drawdowns that we've seen across these major indexes on the results of course, this radical shift in global trade. European Stock 600, that benchmark down 12%. You've seen the drawdown in the S&P 500 closing into that correction territory. We could easily get there today on the pricing of futures right now. The Nikkei over in Japan down 20% in correction territory. Similar picture for the Nasdaq 100, already in correction territory. And over a 3-day basis, on today's pricing around the futures, you're looking at the biggest bust for the Nasdaq 100 since 2020. Let's flip the board and have a look at what's happening in terms of US credit spreads in higher yield. Up significantly. The spread's widening by about 1% just over the last 2 days. This flagging concerns of the credit markets then. Watch US high yield and the repricing that's happening there in terms of how this potentially builds out that picture around recession risks in the US. Briefly touching the futures picture. Further losses being painted today. We're closing in on that bear market for the US. No response in terms of no upside coming through from Beijing's policy focus on stimulus. A significant rout when it comes to the Asian markets, down 12% on the benchmark. The opening trade is up next. This is Bloomberg.